What's up, guys? It's Migs with Market Open. I recently put out a post on the Facebook group and I asked you guys, hey, what is some of the vocabulary words that you guys don't understand that you guys would like for me to cover? So what I did is I put 10 of the most repeated words that you guys did not understand and made a slideshow for you guys and explained it. And I want to explain it to you guys in simple terms. Like, I do have the definitions, like the exact definitions on there. And I will tell you guys what is really important, what is not. But I like to break it down really, really simple for you guys to be able to remember in as easy as humanly possible. So this is Trading and Investing Vocabulary 101. So these are some of the words that were repeated over and over again that you guys wanted to know about. So the words and terms that we're going to be covering today is going to be the term bullish, bearish, what VWAP is, what are gaps, what is RSI, bid and ask, what is scalping, what is swing trading, MACD, and ETF. Okay, so the first term that we're going to cover is bullish. So investors who believe that a stock price will increase over time are said to be bullish. So you can use that term in many different instances, as in we're in a bull market. That guy is very bullish on the stock market, the S&P. He's very bullish on Nvidia, BABA, whatever. So it's basically most investors, as most people would see them. So it's people that want to buy low and sell at a higher price. So it's believed that investors who have sold puts is also considered to be bullish on a stock. Seller of puts has also an obligation to buy the stock and therefore believes that the stock price will go up. So those people are bullish as well. Now, in opposite, the next one would be bearish. So investors who believe that the stock price will actually go down is said to be bearish, and that can be used in very different instances as well as, oh, we're going into a bear market. Oh, she's a bear at heart, or this stock is just throwing up, very bearish signals. It means that you think that the stock price is going to be down. So now, I also heard another origin for these words. They couldn't really quite come up with the exact where or the place that it came of origin, but it is said to believe that the animals were named after the methods that they attack into. So what I mean by that is bears have a downward swiping of their claws when they're attacking other animals. So that is said to be bearish, and it's a downtrend. Bullish is the way that they attack. The horns, they go up, so they go from top to bottom. So that's kind of why I put this picture on here. He's holding it up and he's pushing it up, so it's very bullish of them. All right, so the next term on here is VWAP. So I didn't write out a very long definition for this one because honestly, it's not as important of the exact definition, because all you really need to know is the average price paid for a stock. So this right here is how you get the VWAP, but in all honesty, you don't need to know that at all. All you need to do is just put it on your chart, know what it is, and how it moves. So it's literally the average price that people pay for a stock, and it's based off of volume. So on here, I put an example of a trade that I put up in the room the other day. So this white line right here is the VWAP. So VWAP can be either support if the price action is above it, or it can be resistance if the price is obviously below it. VWAP is also very important because it helps either hedge funds, whenever they're buying large amounts of shares, obviously they want to buy below VWAP because it is the average price that your average Joe is paying for it. So if you think about it, and you're working in a hedge fund and your boss comes up to your desk and asks you to buy 1 million shares of a certain company, you obviously don't want to pay a higher price than what the average Joe is paying for the stock. So they determine VWAP for their bonuses. So they must buy stocks below VWAP, and then they must sell them above VWAP for them to be able to get their bonuses. So having VWAP on your chart can be very, very helpful. Now, gaps. What are gaps in the market? What are gaps in stocks? So gaps are a change in price from the close of the previous day. So I put some examples on here. So Nvidia is a stock it's traded often, every single day, and it's always gaps up or it gaps down. So as you can see, Nvidia closed down here somewhere around 224. But Nvidia actually also follows the market very closely. So if the market's gapping up, that means that Nvidia is going to be gapping up most likely. So as you can see on here, this gray area is after hours, and then this is pre-market trading. So pre-market trading consists from 4 a.m. to 9:30 a.m. right before the market opens. So you can actually buy and sell before the market actually opens for business for the day, but it's really dependent on your broker. Some brokers will let you trade at earlier times. Most traders or most brokers here in the US will let you trade after 7 a.m. But there are some brokers overseas that will let you trade as early as 4 a.m. Also, you can trade in after hours. So a lot of companies actually put out press releases in the after hours. So that is from 4 p.m. to 8 p.m. But now there's also an issue with trading after hours and pre-market. Now, this is a very, very big issue that is actually the main driver for why I don't trade stocks during those times of pre-market and after hours. The issue being liquidity. Liquidity is for your ability to be able to get in and out of a stock. So, in having limited liquidity can be a very big issue when you're trying to get in and out of something. So, by it having very large spreads, that means that the liquidity is not very good. So, I also put on here a level 2 box of typically what it looks like in the after hours or pre-market time frame whenever something is being traded, but nobody's actually trading it. So, markets are forced to put out a bid and ask. So there are people sitting there for them to provide liquidity in the market, but they don't have the spread doesn't have to be very close. So this is what XNet looks like during after hours or pre-market. So as you can see here, there are people selling shares at 1664, but there are people that want to buy at 1625. So obviously there is a large spread in between the two, and the guy in the bid is not going to go over to the ask and pay this price, and this guy is not going to come down to the bid and sell his shares for this much because it doesn't make sense. You would be losing so much money. So that's what I mean by the spreads are large and there's very little liquidity. There are not a lot of shares to be traded during those times unless, and very big unless, the stock is actually in play during that time. So as I mentioned here, Nvidia trades pre-market and after hours. All stocks do or can be, but it's just some are traded more than others. So Nvidia, you can get in and out easier than you can out of something like BRS. BRS is not being traded after hours or pre-market because nobody's interested in trading this after hours or pre-market because the spreads are so large. So as you can see on here that the gray area is a lot smaller because it's not needed on here. So it opens, or it closes here and it opens up here. And then in this one, actually it was a little bit of a gap down, but most of the times it'll just open around exactly the same price of where it closed at the previous day. This was actually probably a down day, so it overall there were more people selling at the very beginning. But typically they open up around the same price regardless. But it's just not being traded during a pre-market or after hours. So that is how the gaps are made. They are exchanges of shares during during times that the market are basically not open. Okay, so RSI. So RSI stands for Relative Strength Index. So it's a momentum indicator developed by noted technical analyst Willis Wilder. Blah blah blah. That's honestly not really that important. If you're into the history and all that, that's cool. But the really important part on here is it is primarily used to attempt to identify, this word attempt, to identify overbought and oversold conditions in trading of an asset. So that is basically what you need to know. You are trying to identify areas that are overbought and oversold with the RSI. So RSI is the relative strength index. It's telling you how strong or how weak a certain stock is. And it's trying to tell you if it's overbought or it's oversold. Now, these are the magic numbers on here. So it's 70 and 30. So anything over 70 is technically overbought. Anything under 30 is technically oversold. So you can apply the RSI on different time frames. You can put an RSI indicator on your charts on a 1 minute, 5 minute, 15 minute, daily, weekly. It doesn't really matter. But it's basically trying to tell you if the stock currently is oversought or overbought or oversold. But in my opinion, the RSI really works best on a daily chart, because remember that stocks get their roadmap of where they're going based on their daily. Now, let me get into some of the details with the whole 70-30 deal. So technically, 70 is overbought. So I put an example on here of the SPY. The SPY is an ETF for the S&P 500, so it basically tracks the market. This is the ETF that most professionals use to be able to get a sentiment on how the market is doing, if it's going up, if it's going down, if it's overextended or whatnot. But as you can see on here, right around here in the 70 mark, so as soon as it crosses over the 70, it's technically overbought. And we've been overbought on the SPY since late December. But just because it's overbought doesn't mean that it can't go higher. Especially with intraday trading and day traders, we buy things high and sell them higher. But always remember, just because it's already high doesn't mean it cannot go higher. So right here at this point, we were technically overbought. But look what's happened since then. Huge gains since then. And we're actually now an 81 on the RSI. So this being obviously more overbought, somewhere in the 90s is very overbought. And that's why people are saying, hey, the market's very overextended, like we're due for a pullback, which I do agree that we are due for a pullback sometime soon. But just remember that just because things are overbought and things are already high, it doesn't mean that they cannot go higher. Now, it goes also in reverse. So as you can see, actually, no, it's not on this chart, but it basically applies the same way. Just because something is cheap and it's a 30 on the RSI, it doesn't mean that it can't go lower. Just because something says it's 30, and let's just say that a company got bad news and it's been selling off basically ever since, and the company could basically just go to zero and go, not be public anymore. But just because something is cheap, it doesn't need to be bought. Just because something is low doesn't mean it can't go lower. So always remember that. Okay, so now the bid and ask. This is something that I talked about a little bit earlier. So the bid and ask is actually something very, very simple. A good analogy would be to think about it is as just as an auction. So people here, this is a level 2 box. People are auctioning off and are trying to buy and set bids for the shares that they have available. So this is a basic level 2 box, and each color represents a certain price. Basically, it goes from high to low. So all these people here are wanting to buy shares of ESIO for 2604, and these people are just sitting here with an order out, waiting for these guys to come down. So the same thing, these are the sellers. So these are the buyers, these are the sellers. These guys are trying to sell their shares for this price. Now, what this means is that there's 300 shares to be sold at 2608. So this guy is literally just sitting there with a limit order saying, I am not selling my shares for any lower than 2607. Now, I'll explain to you guys what the time and sales window is here and what it portrays. So the red on here, it means that the guys in the ask, the guys that are selling, means that they're hitting the bid. That means that they're selling their shares that they want to get out right now. They are not going to sit here and wait any longer. So the people on the ask that are asking this price, they're saying, oh crap, okay, I really want to get out, let me hit the bid. So then they just automatically sell their shares to these guys, and that's what these red numbers are. Now, in the opposite end, the 2604 guys, the guys that are sitting here on the bid, and they're portrayed as green. So if these guys are saying, hey, I don't want to miss the move, I really want to buy into this the stock right now, these guys are hitting the ask. They're saying, I want to get in, I don't care what the price is, I'm getting in right now. So green is portrayed as buying, red is portrayed as selling. But now you're asking yourself, wait, what's all this white then? So what this white is transactions taking place in between the spread. That means that there are people that are putting their price for them either selling or buying in between, and they're buying at an in-between price of the spread. So if you notice on here, all the white is between the spread. So it's not either 2604 or 2607. So it's their prices that are met that can come from either different places, different routes. It can be either dark pools, but they're just basically exchange of shares in between the spread. So if you notice on here, all the white is between, and it's not either or. Yeah, and as I mentioned earlier, the spread is just the difference between these two. So you would say that this stock has a 3-cent spread, which is very good for a higher price stock. Now, also, there are higher price stocks that have bigger spreads, and that's not anything that you want to get into if it has a larger spread. Now, if you think about it, liquidity means that a lot of the shares that are being traded back and forth. But now, if there's a stock that has poor liquidity, that means that the spread is going to be very large. So for instance, instead of 2607, let's just put this at 2637, and we'll leave this guy here at 2604. Now, if the spread was over 30 cents, that means that as soon as you buy into the ask at this price, you're automatically down 30 cents. So that is one of the reasons why you do not want to trade anything with a large spread, because you are automatically down money. You want to get into something that has a relatively low spread, or you want to be able to put out an order in between and be able to get filled closer to what you want. Okay, scalping. Couldn't really quite get a picture of this because it's kind of self-explanatory. So scalping is trading a strategy that attempts to make profits from a small price change. So you're basically buying and selling and holding for a very short time, and you're buying large amounts of shares. So you could be buying at a breakout, and instead of holding, try to get the meat of the move or the whole move, you're buying basically an obnoxious amount of shares, and you're selling it very quickly. So you buy it at the breakout, it goes your way, it goes up, 10, 15, whatever, 5 cents, it doesn't really matter. It's just a small amount. You're grabbing a small amount of time that you're actually going to be in the market, and then you automatically just sell it when you're already up at a profit. So these people are attempting to actually prevent larger losses. So if you expect something to break out and it mostly always goes your way, you're limiting your losses, yes, but sometimes it can go the opposite way. And when you're holding so many shares, and if something goes the other way, it can get bad very quickly. It is a legitimate strategy. There are other prop traders that are out basically just scalping moves. So you're making a lot of trades, and a lot of them, if you're any good, obviously they're going to go your way. So you're in attempts trying to stack up a lot of small moves to be able to make a large amount of profits, because it's slow and steady basically wins the race. So you're just stacking up a whole bunch of small profits. You're scalping right off the top of it to basically just scalping the move to be able to stack up a large amount of money, basically. Now, swing trading. So I've talked about this before, but you're basically holding a trade for multiple days. It can be anywhere from 2 days to weeks or perhaps months. Any longer than that, and then you're going to start getting into the whole investment realm. When you start getting into months, like over 6 months, 9 months or so, you're starting to get into the investing. It's kind of a little bit of a gray area. So this is one of the types of traders. I also have another video that kind of breaks down all of those, but just swing trading in general, it just means that you're holding something for multiple days, multiple weeks, or multiple months. So swing trading is basically done mostly on a daily chart. You're trying to see where the stock is going, and you're making your moves, your buys, and your sells based off of the overall trend of the stock. So swing trading is very popular amongst people that have very busy schedules, work full-time jobs, and you can actually swing trade off of your devices, so like your phone, um, tablets, in your spare time. So TD Ameritrade actually has a very good online platform for something like this on the apps. So I've used it in the past, and it's very good. Now, MACD. MACD is actually something I personally don't really use. I've been in the market long enough where I don't really need something telling me if it's a buy or a sell. But if you're a little bit newer and you need some sort of affirmation on what you're thinking, this can definitely be for you. So what MACD is a moving average convergence divergence, which sounds kind of weird, honestly, and is a trend following momentum indicator that shows the relationship between two moving averages. Those two moving averages is calculated by subtracting the 26 exponential moving average and the 12 EMA, basically, so exponential moving average. And then you have a 9, which is basically the signal line. So I'll show you guys here an example on here, but just to simplify, it's basically a plot with two lines, and whenever they cross or they separate, or it'll give you a sort of signal whether to buy or sell. So now this is an example of basically what the MACD on here. This is on stockcharts.com. The top of it gives you the RSI, the bottom of it gives you the MACD reading. So basically it's telling you that the red line here is the signal line. So this is the 9 that it was talking about. And the black line is the MACD line. So every time that it crosses, if the MACD line comes over the signal line, it means a change in trend, and it means that it's going to start heading up. Now, you're supposed to hold it until a change of trend. So you're basically just waiting for it to come back down. So in terms, it's basically tracking the movement of, so this is NVIDIA, and it's saying that here around the 19th probably, it was a buy. So this is a buy signal from the MACD telling you, hey, there is a possible change in the trend, and this would be a good place to buy. So as it's climbing over, it's telling you, hey, this is a good place to buy. So as you can see on here, it actually worked out. So you bought low, and you're still up here waiting for the MACD line to cross over the signal and for it to give you a basically sell signal. Now, there can be a very negative side to this because as you can see here earlier on in the chart, like this part right here is very easy to read. It's very ideal, but it's not always like that, because as you can see on here in the rest of the chart, it goes over, it comes back under, it goes over, it's just a mess. It is just seriously a mess. And could you imagine trying to say, okay, well, I think I should sell here, and then it goes under the line, but then it comes right back. So it can throw false signals, and it can be hard to follow at times. But what you're looking for is something more like this, on a very clear uptrend, and you're waiting for it to basically cross over. But the entry here on the MACD would have been here, right around the 19. It's on a very clear downtrend, so it's selling off, and now it's telling you that it's crossing over. So in this whole 6-month period, the only good buy spot would have been here, based on the MACD. You can actually look up the MACD because there's so much information basically on the MACD. I don't want to, since I don't really use it, I don't want to get too detailed because honestly, I don't really know too much about it. It's just I know the simple basics of it, what it does. It's just I don't really use it because I can tell just by the candlesticks themselves whether something's good or bad. But you can definitely find videos out there that go very in depth with the MACD. There are trading strategies based off of the MACD, and they can be very profitable for you. It's just I don't follow them. Okay, so an ETF. An ETF is a exchange traded fund. It's a marketable security that tracks an index or a commodity. It can track bonds or a basket of assets like an index fund. So basically what that means is that it tracks basically a whole market. So I put a list on here of very popular ETFs. So this ETF, FXI, tracks all of China. EWZ tracks Brazil. This tracks real estate. And it basically just tracks the strength of it. It tells you whether it's healthy and it's going up, or it's going down, and it relates back into the stock market. So let's just say that you're thinking that the real estate market is kind of low and you would like to get into it now. So what you can do is you can actually find an ETF that represents the real estate market, and you can actually buy into it and you can trade it as such. Another example would be like rice. Let's just say that you think the prices in rice are going to rise here in the near future. So typically, or back in the day, you would have to just stock up on a lot of rice. I mean, like literally, just go buy a bunch of rice, hold it till the price goes higher, and then turn around and sell your whole stock of rice. You don't really have to do that anymore because they've made these ETFs which track these commodities. So instead of buying a whole bunch of rice, all you have to do is just find the ETF for rice and trade it as such. So now, basically anything that you want to buy and sell and hold and trade and all that, you can actually just find the ETF for it and trade it. Very popular one on here is JNUG. JNUG actually tracks the price of gold. But the difference between JNUG and gold, like GLD, or is it, yeah, so it's GLD. This is actually a triple leveraged ETF, which means that it moves 3 times as much as the regular price of the actual commodity. So I believe the price of the actual gold is a lot higher. It's definitely a lot higher. So this is something that it's smaller priced, but it moves 3 times as fast. So as you can see on here, it moved from 19 all the way to 2020 because the actual price of gold doesn't really move that much. So it's not really that appealing to trade. So what you would want to do is trade something like the ETF, either the ETF or the inverse ETF if you're bearish on it. But it's triple leveraged, so it actually moves and you can actually make profits off of it. And that covers all of the ones that were mostly asked in the group. So if you guys have not joined the Facebook group, make sure to click on the link below and join our Facebook group. It's completely free, but everything is on there is obviously private. It's a bunch of like-minded individuals that are sharing ideas. Actually, I personally share my watch list every single morning with you guys for you guys to be able to make profits off of. If you guys haven't followed me, I'm also on Twitter, on Instagram, and obviously the Facebook group. I post the watch list also on my Twitter as well, and I keep up with my Instagram, so you can definitely follow me on there. Thank you guys for watching this video. If you guys have any questions, make sure to leave it down in the comment section below, and I will talk to you guys next time.